How's it going, option sharks? This is your option coach here. And as you can see, today's a beautiful day in the Pacific coast. Okay, so let's kick it off. Today, I want to talk a little bit about selling puts, cash secure puts. And why is that advantageous? Why is that beneficial? So compared to just the traditional basic buy and sell investors where let's say you want to build a position on Apple, and Apple, for example, is trading at $100 per share. You can, instead of just buying the share at $100 per share, you can sell a cash secured put, meaning you can decide on what strike price you want to own Apple share for. So, for example, if Apple is trading at 100, you can then decide to sell a cash secured put for $90 or $85. And this essentially lets you generate income and build a position and enter a position. Now, depending on your expiration date, at the day of expiration, if Apple trades at 90 or 85 below, you'll get assigned those shares because that's what the contract is for. But hey, it's okay. You don't mind owning those shares. And more importantly is you have to decide the strike price that you choose to own. In this example, Apple is a good strike price for you. So then you can just go with that strike price. And then if you get assigned the shares, then bingo, you get to own Apple at a strike price that you don't mind owning it for. And that is by far advantageous compared to just buying it. Now, obviously, you could always buy the shares if you absolutely just need to gain entry on it right away. But it's much better to sell cash secure puts to make money and gain entry. Okay, especially when stocks have ran up and it's not favorable to buy it at that high price. So yeah, it's very short, and it's very, and this strategy, cash secure puts, is very, very, very safe. It's really hard to mess that up. But I do understand if you are a beginner or still new to options and you want some hand holding, some coaching, a walkthrough on how to do this process, understand what are the risks. There is a little bit of a risk. That's if you get assigned the shares of Apple and Apple goes to zero. But the likelihood of Apple going to zero is very unlikely because Apple, at this very minute, if I snap my finger, they are making income. They're generating revenue. So you want to do a cash secure put on companies that you don't mind owning, quality companies. All right. So in this video, I'm also going to include a coaching call with one of my students, and you can see exactly how I work and how I'm able to help my students generate consistent income, passive income, and do it very safely. All right. So wherever you are, enjoy your day and look forward to hearing from you, and like and subscribe, and also book a time if you do want to get some coaching and get some help. All right. Enjoy your day.
Let's take a look. So here's the options chain. We're going to do a call credit spread. This is a bearish neutral strategy. What we're saying essentially is that MD is not going to go above a certain strike price, right? It's going to keep trading sideways or keep dipping lower. I personally did to keep things safe. I did, as you know, the amount of money from what I did about 15 minutes ago, this has changed, but this is a super safe trade. So you sell a call, right? Strike price 100, okay? And you see the delta, the Greek is here. We're changing the delta. Say, where's the delta? Usually it's on the bottom.
Yeah, so the
delta is only 22. Okay. Yeah. So you sell the call at 100 and then you hedge by limiting the cost of this because you see the max loss is unlimited. You just buy, and I do a 7-point spread. So you can do a buy at 107. All right. So there you go. Total credit is 0.65, I think. I can't see that. 68 or 65. But either way, you can see you're collecting $67. You're using collateral of 833. Okay. Right over here. Max profit 67, max loss 63 something. I can't see because it's a bit small on my screen. But obviously we'll do more contracts because you see your buying power is 80,000, right? So you can do. I would just keep things simple. Don't need to go to just do 10 contracts. So you see collateral's at 6,300.
Right.
Yeah, and then what do you call it? What is the spread here? 65? Is that 65 or
66? Yeah, it's a low likelihood.
66. So we'll do 68. Yeah. Right. So you collect 679 for this trade. You want to do it? I have the same trade.
Okay, cool. Yeah. So it's a 3-day trade.
This expires this Friday.
Okay.
Let's see if it gets filled. You got filled. Okay. So this is a call credit spread. It's a bearish neutral strategy. We're saying that AMD is not going to trade above 100. Okay. And we also went beyond that because there's a resistance level at 95. When we looked at the chart earlier, there's a resistance around 95 and 96. Every time it went to 95, 96, it's sold off. Obviously, if you pick closer to 95, 96, you'll see the premium's a lot more juicier. But we want to be safe. We don't even want to have to sweat it. Right? So we just pick a 100 strike price. We still collect close to $70 per contract, make about $700 there. Okay.
Okay.
Right.
Okay.
And you only that's 10%. You also collateral is around 7,000, right? So you make 10% in one week. So literally, this type of advanced strategies are very lucrative. You gotta know what you're doing. You can make 10% per week. That's 40% a month, right? It's significant money. Okay, but you cannot be greedy. You got to pick. You don't want to. There's guys that like to pick 219, 175. No, we're not here to sweat bullets here. We want to just collect money nice and safely, and do our technical analysis and have good understanding of pulse.